everybody, and welcome to the Daily Currency Call presented by Forex Trading Asia. And we've got a few people coming in here. Welcome to all the LCMS Trader Club members that are catching the call live as well. And I hope if you did hang around a little bit later into the session after the Wednesday night live trading call, that you did take advantage of the trade calls that were discussed as well. And if you did actually stay up until the FOMC release, hope you're not feeling too tired today as well. And if you are watching this on YouTube, a welcome. And if you are wondering what this is all about, this is the Daily Currency Call with Forex Trading Asia. And we'll just do a quick introduction as well, just to get things started. And again, welcome as well. And to all the Forex Briefcase account holders, you're probably feeling well refreshed and would have seen some gains made in the account. So we're just over 4% for the trading month, with today and tomorrow remaining. So really strong results. And that's on the back of 5% last month as well. So some considerable gains have been made these last 2 months. Really nice way to end the year. And the introduction, guys, just to get going, it is episode 442. It's the 16th of December. And the currency call is presented every Monday to Friday at 11 a.m. GMT +8. And the currencies we look at are as follows. So on Monday, we do Aussie and Kiwi. Tuesday, the Euro. Wednesday, the Pound. Thursday, Yen and Gold. And then on Fridays, we do CAD and crypto. And in the currency call, we'll look at the market economic updates, the key support and resistance levels, trade ideas, and much more. Including today, obviously, we've got Kim Hong just going through the FOMC news as well, which was quite extensive. So he will be going into a little bit of detail as to what happened very early this morning. Singapore time was around 3 to 3:30 is when everything was happening. And in the currency call, we aim it to be very beneficial to both the long-term investors and the short-term traders. And we'll go through what could move prices, potential trade ideas, and we'll also discuss the potential targets and risks in those trades as well. Finally, a disclaimer: any information shared during this session is not intended to be a trade recommendation. It is solely the opinion and views of the speaker. So please remember to do your own analysis prior to entering into any trades. Now, like I just mentioned, we do have Kim Hong here, currency strategist at LCMS Traders, and he'll just be discussing the points to really focus on from the FOMC economic projections and also the press conference. There was a lot going on, but we all know Kim gets very passionate about this. So make sure you take some notes, guys, and enjoy. So over to you now, Gimme.
Thank you, Scott. Passion. Yes, passion. But I'm quite tired right now. I'm not sure why. I guess because I'm just too connected with the market, even though when I'm sleeping. All right. Okay. FOMC. Let's head straight to the statement. Where is it? Where is it? Okay. So like the link that I shared yesterday, it links directly to this page over here. Okay. So you just have to scroll all the way down, go to December 14 or 15. Okay. And then head over to the HTML version of the statement for clarity purpose. All right. Come on, load faster. Okay, great. So let's just go straight to the fourth paragraph. First thing first, they held interest rate unchanged, okay, at the targeted range of 0 to 0.25%. Okay. Then, okay, here comes the fun part. Then they decided, okay, to reduce the monthly pace of its asset purchases by 20 billion for the treasury securities and 10 billion for agency mortgage-backed securities. That means a total of $30 billion. Okay. In short, they have actually increased, okay, or doubled the pace of tapering, okay, from the previous 15 to, well, from the current 15, okay, to the 30 that we'll be seeing starting from next January, okay, which is a good thing, right? I mean, the whole market was actually expecting this to happen, okay. Nonetheless, it's still a good thing, okay. It's a very hawkish move coming from the FOMC, all right. So with this new pace of tapering, okay, to begin in January 2022, it will take just 3 months, okay, January, February, and March 2022 for these tapering to finish, to conclude, all right. Hence, by the end of well, starting from April 2022, the Fed will no longer be purchasing any more bonds, okay? Any bonds, any treasury securities, or any more mortgage-backed securities, okay? So that is pretty much the end, almost the end, I would say, almost the end of QE, okay, by the end of March 2022, all right? So that being said, okay, from then on, they can actually start to, well, consider a rate hike. Okay, it's just a matter of when the rate hike will take place. Okay, which is why I mentioned yesterday that due to this whole crazy high rising inflation in America, okay, close to a 40-year high level, the central bank will want to, wind up this whole QE as soon as possible before, so that they can actually have the time flexibility, okay, to decide when interest rate hike can take place. All right. So that's pretty much it for the statement. Okay, that's pretty much it for the statement. The committee's assessment will take into account a wide range of information, including readings on public health, which is the current COVID issue, okay, labor market conditions. Well, employment in the US hasn't reached the maximum employment level, but it's making very, very good progress, okay, according to Powell, and I mean, according to the data, right? We are like some close to 4 million away from 4 million jobs away from the pre-pandemic level, okay? And inflation pressures and inflation expectations, which, as you guys already know, close to 40-year high, and financial international developments, okay, the usual standards. Now, with that, we will actually head over to the next page, which is the economic projection. Okay, so oops, not this. Where is it? Where is it? Okay. So coming back to the previous page of the FOMC information, all right, you see this projection materials. Okay, it's a quarterly released material, right? So for this, we would want to go to the PDF version instead, because it actually display the dot plot that we want to take a look at, all right? But the HTML version does not actually show it. So the dot plot, okay, it actually shows, what level of interest rates for a certain year will be, okay? It's pretty much like a projection from all the central bank, from the central bank committee members, okay? So we see that, you know what? Sorry, I'm just going to go straight into the picture that I've put up. All right, this is the one, okay, whereby I actually, well, sort of like put both the September's, okay, and the December's, what do you call it, dot plot, okay? So in September, let's just focus on this column first, all right? This column will be 2022. 2022, we see that majority, okay, well, pretty much majority of the, I would say, members actually expect interest rate to remain at the let me just put it here, okay, to 0 to 0.25 level over here, okay? So the horizontal bar is actually the 0 to 0.25. We actually see like 1, 2, 3, 4, 5, probably like 8 to 9, okay? 8 to 9 members expecting interest rate to remain at 0 to 0.25. Like I mentioned, okay, if what we want to see is shifts in the dots, okay? Ideally from the bottom to the top part of the dot plot, all right? And then if we were to look at the December's meeting, okay, which is the one released just a few hours today, we see that now there is actually no members, okay, zero member expecting interest rate to remain at the targeted range of 0 to 0.25 for 2022, which is a good thing. So where did they go, right? They all went above. They all went up to like majority. Okay, majority are actually expecting some. Let me do this again. Majority are actually expecting interest rate to be at the targeted range of 0.75 to 1%. Okay, so this is actually a very, very, very hawkish move. All right, tapering has doubled. Okay, now we are seeing the sense of urgency coming from the Federal Reserve. Okay, the sense of urgency. We need to get this whole tapering out of the way so we can have the time luxury. Okay, well, I wouldn't say time luxury, but the time flexibility to actually increase rate in case, okay, inflation were to go way higher, breaking the 50-year level high, 60-year level high, maybe 100-year level high or something like that. Okay, so what this means over here, okay, now we just focus on the December's dot plot over here on the right side. Okay, so what this actually means is that, you know, there's like 1, 2, 3, 4, 5, 6. So I think probably like 10 or 11 members are actually expecting interest rate to be at 0.75 to 1. So what this means is that around 10 or 11 members are actually expecting 2 rate hikes, at least 2 rate hikes, okay, in 2022, okay, because normally when it comes to rate hike, okay, the Federal Reserve will increase by, you know, 25 basis points, okay, or 0.25% per rate hike. All right, so, you know, for interest rate to hit like 0.75 to 1, you know, if it's 1, that means it's right now we are at 0 to 0.25, right? If 11 members are actually expecting interest rate to hit the 0.75 to 1%, okay, that would require like a 0.75 increase in interest rate, which actually equates to 3 rate hikes. Actually, yeah, instead of 2, it's actually 3 rate hikes. So yeah, actually, I think it's like 11 and then 12, 13, 2 more on top, 2 more members. Let me just get this. 2 more members, okay, are actually expecting interest rate to be at a range of 1 to 1.25. So total, we have like 13 members, you know, expecting interest rate to be at least, at least 3 interest rates to take place in 2022. Okay, previously meaning like some 6 months ago, okay, from the monetary policy statement, we see that, you know, the Federal Reserve is not expecting interest rate to hike at least until 2024, at least until early 2024. Okay, right now they are actually expecting 3 rate hikes in 2022. Okay, that is definitely a very, very hawkish move, a tone coming from the central bank. Okay, so we have a doubling of QE tapering. We have a very positive shift in timeline. Okay, carrying forward the rate hike. Okay, and the next thing we want to pay attention to is inflation. Okay, so during the press conference, Jerome Powell actually mentioned like the pace of inflation is uncomfortably high. Okay, finally, the pace of inflation is uncomfortably high. So he actually mentioned that I do not have the whole transcript right now. It's not been released yet. Okay, but if you were to listen to the press conference, okay, he actually mentioned that yeah, it's uncomfortably high. And back in the November's meeting, they were actually the members, okay, of the FOMC were actually considering to carry out a $30 billion per month of QE tapering, okay, which is actually what we are seeing now, right? They were actually considering this already earlier on. It's just that they did not mention it, you know, the Fed being the Fed, trying to, you know, not create too much movements in the market, okay, trying to be more conservative, kept that to themselves. But this time around, you know, Powell actually said that, well, back then we were actually considering, you know, a faster pace of QE tapering. All right. So that's it for inflation. No more transitory inflation. All right. The term transitory has already been, you know, sent to the museum. Okay. So from now on, we can expect inflation to be something of very, very, very high impact data, economic data. Okay, because any more rise in inflation will actually create trouble for the central bank, for the Fed. Okay, so let's head back to the economic projection. Okay, because there's one last piece of information that I would like to share with you guys. Well, that the Fed has shared with us. All right, which is the economic projections for the economic indicators. Okay, so we'll just focus on the median, forget about the central tendency and the range. All right, let's just look at the median for now. GDP, okay, is expected. Well, when we look at GDP, well, when we look at these economic indicators for now, you know, it's coming to an end of 2021. We should just focus on 2022, okay, which is the near future. We can see that, okay, GDP is expected to be 4.0, all right, for 2022, okay, as opposed to the previous forecast back in September, okay, of 3.8%, which is actually, the Fed is basically expecting economic growth to speed up, okay, for the year of 2022, which is a good thing. Okay, and then in 2023, they actually toned down from the expectation of 2.5 to 2.2, okay? But to be honest, 2023 is still quite some time away from now, right? It's at least like some 1 year away. So it's too early to tell, okay? So let's just focus on 2022. Unemployment rate, okay? Unemployment rate is expected to decline, okay, to 3.5%. Previously, back in the previous, projection in September, the central bank was actually expecting unemployment rate to actually fall to 3.8%, okay? So they have since revised downwards to 3.5%, okay? A downwards revision to unemployment rate forecast projection is actually a good thing, okay? And then when it comes to the Fed's preferred way of inflation measurement, okay, September's projection was 2.2, okay, and the most recent projection is 2.6. Hence, there's a expectation that inflation will rise higher than previously anticipated, okay? So, which is a good thing as well. So overall, we see that economic growth, unemployment, and inflation, they have all been in the near term, okay? In the near term, has been revised optimistically, positively, okay? Which is just adding on more hawkishness to the two major points that I've mentioned earlier on just now, okay? So we have all these good things coming out from the Fed, okay? But I'm not sure how many of you actually traded the FOMC, okay? But there was an initial strengthening of the US dollar, okay? I was actually, Jean actually traded. So there was actually initial, strengthening of the US dollar. But then, okay, it actually sort of like retraced, okay? I wouldn't say, I'm not sure if it's a retracement or if it's a weakening for good kind of thing, okay? But my take on this, okay, is that this is mainly due to a strong sell-off, sorry, not strong sell-off, a strong rally in the US market, equities market, okay? Actually, I shouldn't have unshared my screen, but now I'm sharing it back again, okay? So if we were to look at this, I've actually compiled these three charts over here. The first from the top is the S&P 500, okay? The second one is the NASDAQ 100, and the lowest one is the Dow Jones Industrial Average, okay? So what you guys are looking at right now is the hourly chart, all right? Hourly chart, and you can see that this is arrow pointing at this green candle here, right? You can see that it's all like long green candles as compared to the previous hours, okay? That was actually the time when the Federal Reserve monetary policy decision was being announced. Okay, that's the 300 to 400 GMT plus 8, okay, timing. So you guys can see that, across all three indices, there was actually a strong rally, okay? Now, remember, when there's a strong demand of equities, okay, what do you need in exchange to buy stocks? You need money, you need cash, right? So when there's a strong demand in equities, okay, the demand for cash will decline. Okay, it's actually an inverse correlation between cash and equities. Okay, because you need cash to buy, right? I mean, right now, if I were to tell you that, oh, the US economy is doing fantastic, okay, hence the central bank, Federal Reserve, is actually trying to get rid of QE as soon as possible so we can hike interest rate to tame the super high inflation, okay, what would you do, right? You'll be thinking like, okay, maybe it's time to step into the equities market to do some investments and things like that, right? And, from the point of view of cash, okay, you'll be thinking, why would I want to leave my cash in the bank, okay? I mean, yes, interest rate is going to rise, but the thing is, right now, the economy is strengthening, okay? So there will be a tendency whereby most of the market participants will actually enter the equities market. Hence, the rally we have seen here, okay, from the three major indices, which pretty much, I think, sums up the whole US equities market, okay? So because of that, we actually see a weakening in the US dollar. But, okay, will this weakening of the US dollar be a sustained one, okay? Personally, I don't think so, all right? Personally, I don't think so, because like I said, the reason for this weakening of the US dollar is just due to a temporary decline in the demand of US dollar, because people are starting to enter the what do you call it, the equities market. Okay, hence the short-term decline, the short-term weakening of the US dollar, right? So we can actually expect, okay, we can actually expect the US dollar to recover, especially, all right, with this whole, for example, okay, let's just take pound dollar, for example, right? I mean, right now we are seeing like a strong rally in pound dollar, okay, but we know that fundamentally in the UK, okay, it's actually very weak, right? We have ongoing Brexit issues that hasn't been resolved since forever, okay? And then we have like Omicron cases rising, and then Boris Johnson is trying to come up with, well, has really came up with a plan B, which actually encourages people to work from home, okay? And of course, there's some new political issues going on in the cabinet, in the parliament, UK parliament, okay? And there are like more than 50% of the, what do you call it, the parliament members, okay, members of parliament actually voted, well, I wouldn't say vote, but hope that, you know, hope for a change in, hope for Boris Johnson to step down as the Prime Minister of United Kingdom, okay? With all this uncertainty coming in, okay, there is no reason for us to expect the British pound to strengthen, okay? So if you see the pound dollar is actually strengthening at the moment, it's likely due to the short-term weakness of the US dollar, okay? So if you want to buy pound dollar, sure, go ahead, but just, you know, just really keep it short term. Be aware that, you know, it may actually just do a rebound, a reversal, or however you want to call it, later on when the European market or the London market would open at 1600 GMT plus 8. Okay, so just be wary of this. Okay, I mean, this is, the pound is just like an example. Okay, we are seeing other areas like Australian dollar, New Zealand dollar, dollar CAD, all strengthening as well, okay, against the US dollar. It's more likely that the US dollar weaken against the major currencies, okay? So with that, okay, do we have any questions? I think we have, right? Can finally do his job after being reappointed. Well, yeah, I guess that's what Donald Trump will be happy to see, okay? You know, sooner hike of interest rates. What is your take on bond yields? They remain in a tight consolidation. Was expecting a spike here after the Fed acknowledged that inflation is a reality now. Okay, so we know that there is actually a positive correlation between bond yields and currencies. Okay, so okay, let me see if I can get the chart out. Bond yields. So it's US 100, US 30, US 100. Let's just look at US 100. Okay, maybe let's just look at US Treasury yields for 10-year, because 10-year is the what do you call it? The benchmark. Okay, the benchmark. US 10Y government bond yields. Let's see what's happening. Let me get my screen up again. Where is it? Here. Okay. Just change it back to one panel. US 10Y bond yields. So what actually happened? Aha. Okay. So the market is pretty much closed right now, right? Am I right? It's not open at the moment. 1000 hours, correct. So let me just put a line here. Now, this dotted line, this vertical dotted line that indicates this candle over here, this bearish candle, why do I have so many lines? Okay, is the hour that it's likely going to be the hour that the FOMC announced their monetary policy decision. Okay, so we actually see, well, previously we actually see like long shadows, you know, like what you mentioned, like volatility and noise and things like that. Okay, but with this dovish, or with this bearish candle over here, it's likely going to move with respect to the US dollar, the weakening of the US dollar. Okay, but still be careful, because the thing is, like I mentioned, the weakening of the US dollar is likely going to be temporary. So if that's going to be the case, and if the reason for the weakening of the US dollar is not because US is weak, okay, it's just because there's a supply and demand, a change in a change in the supply of demand of the US dollar, then we can expect this weakening to be temporary. Then, okay, the government bond yields may not actually weaken as much as, if there is a weakening of the US dollar due to some fundamental reasons. Okay, right now we are not seeing a fundamental weakening of the United States, right? Because of all the good stuff coming in, right? The hawkish tone coming in from the Federal Reserve. So right now, yes, bond yield is likely going to be very unclear right now, with these long shadows here and there, traders not very sure where to go and things like that. Okay, it is likely that we are going to see consolidation in bond yields. Does anybody actually trade bond yields over here? I'm not sure. Thanks, appreciate the insight. You're welcome. Okay, I'm not sure if anybody actually trade the bond yields. Personally, I don't trade the bond yields, but I do use the bond yields, okay, especially the US 10-year Treasury, exactly for correlation of the US dollar. That's what I always do, okay? So normally, like I mentioned, if you see like a strong rise in bond yields and things like that, chances are the US dollar is likely to move upwards as well, okay? It's likely going to strengthen against the other currencies. Of course, it depends on the fundamentals of the other currency as well, right? Okay, so no more questions, I see. Okay, before I hand back to Scott, I have one last thing. Promise, this is the last thing I'm going to share today, all right? It's actually regarding the RBA, all right? So earlier on today, the Governor Low from RBA actually had a speech, okay, addressed to CPA Australia, Riverina Forum and things like that. I was just telling one of my colleagues yesterday that this speech is unlikely going to cover any monetary policy related items and things like that. Guess what? I was wrong. He actually spoke about monetary policy, which is why I would like to share with you guys what he actually spoke about. All right. So long story short, okay, right now they are actually the QE, okay, is actually maintained at the current rate until February 2022, before the RBA would carry out a revision of whether or not they should carry on with this at this pace or carry out a faster tapering. Okay, but then like I mentioned, the next meeting is, I think it's on 30th of January, okay, which is actually not in February, and they probably would want to sort of like have a decision being made before February, right? So I guess that's probably why Governor Low actually shed some light on this whole thing. Okay, so all in all, over here they said that ahead of that decision, the board will consider the future of this program, of the QE program, okay, at its next meeting in February. Ahead of that decision, we had a preliminary discussion. There goes the preliminary discussion, all right, of 3 options at our meeting last week, with all 3 options based on the premise that the economy does not experience another serious setback. Okay, the first option, okay, is the crucial one, I would say. The first option discussed was to further taper the bond purchases from the current rates of $4 billion a week, with an expectation that the purchases would come to an end in May. Okay, that is what we want to see. We want to see specific months, okay, not day. Day is going to be too minute, right? We want to see specific month of when QE will end, okay? And in this case, we finally got it, okay? It's May. Well, likely going to be May is expectation, right? I mean, things can change and things like that. But as of now, we get more clarity coming in from the Reserve Bank of Australia as to when we can actually expect QE to end, okay? It's May 2022. Good, that's good, all right? Second option. The second was to taper further and then review the situation again in May. That is not a very nice option, okay? It's actually slightly worse than the first one. Yes, they can still, talk about it in May, but what we want to do is to end tapering as soon as possible, okay? And have a fixed timeline of when it will end, like the Fed, right? We can actually expect QE to end, or QE tapering to end in March, okay, 2022, okay? The third option was to cease bond purchases altogether in February. This is the worst option out of all 3, okay? If they were to cease, this is the best option, is to cease bond purchases, okay? Which means the current $4 billion a week will actually be tapered all in all to 0 per week. Okay, actually, yeah, this third option is the best out of the three. Okay, this means they are going to put an end to QE, and after which they would be considering a rate hike soon. Okay, but wait, there's more. Okay, if you were to look at the end of the statement, okay, unlikely they're going to hold. Okay, unlikely they're going to carry the third option. Okay, if they were to going to carry out the third option and cease bond purchases altogether in February, okay, the central bank is still not going to expect an interest rate hike in 2022, because over here, the second point that I want to make is that the Reserve Bank board will not increase the cash rate until actual inflation is sustainably in the 2 to 3% target range. We are still a fair way from that point. In our central scenario, that condition for an increase in the cash rate will not be met next year. Okay, will not be met next year. So based on this meeting, based on this speech by Lowe, we can actually expect no interest rates from the Reserve Bank of Australia in 2022. Okay, that is like the whole. I mean, after giving us this hope, you may actually consider to cease bond purchases. You may actually cease it in May, cease it in February, and things like that. You end off the speech telling us that, we don't expect an interest rate hike in 2022. Okay, so what to make out of this statement? Okay, I would say, all in all, I'm still positive. I'm still receiving optimism from Governor Lowe. Okay, because we actually see a clearer timeline of when QE is going to end. Okay, latest by May, earliest February. Okay, that is a slight improvement. But then, Governor Lowe being Governor Lowe, he always doesn't want to give people that false hope. Okay, unlike some other reliable central banker. Okay, Governor Lowe always like to give you guys share with us the options that the central bank has. Okay, which is good. But then before we get all happy, okay, all happy over what they have to do, he will just put in this one line saying that, but we will not be, looking at an interest rate hike in 2022. But the wage inflation is not expected to increase to our targeted level, targeted range. Hence, we will not be looking at a rate hike and things like that. Okay. So yeah, I think this is a very important speech out of those non-constructive ones that he has been giving most of the time. Okay, which is why I'll be sharing this link with you guys. Okay, so at the moment, Aussie dollar, yeah, I'm personally a bit positive on Australian dollar because of this speech that he just gave earlier today. Okay, so I don't think I see any questions on the speech. All right. Okay. So that's what I have to share today. With that, I'll hand it back to Scott.
All right. Thanks for that, Kim. And again, guys, strongly encourage just to make sure you do watch the recording of this. I watched the video again and go through in detail with the timestamps, just so you can jump to anything that, you are a little bit curious about or want to revisit. So I'll get straight into the US dollar now as well. And thanks to everyone that did jump on the call last night. And there were, a few trades that were called out, and it seemed like a few people did make some good pips as well, which is fantastic. And so with the US dollar, we've got the 4-hour time frame up here just with Sam Trade. And it was an interesting point that was brought up with the bond yields as well. And it is a nice way to track just what the market is feeling in regards to how they are behaving, because we have seen something interesting. And so we do have the US dollar. It did obviously spike up at the news, but really, as we shared yesterday, what the market was expecting was pretty much met with the 3 rate hikes and the tapering decrease as well. In fact, we might see, it's going to be interesting to see how they squeeze all that in and why they're actually still, offering quantitative easing. So, I actually am leaning towards potentially an abrupt ceasing. We'll see, because it seems that Jerome Powell is a little influenced by Joe Biden, which he shouldn't be. But the reason really why he flipped, if you look at all the information, is that he didn't want to get fired. So I bet he still thinks it's all transitory. So he's probably going to have to get squeezed a little bit more by Joe Biden a little bit. So we'll see. It could get very interesting for the US dollar. But from a shorter term perspective, there isn't really a lot of news out. I'll just quickly go to that now, just to see, what's going on. We did have weaker retail sales as well come out, and that sort of, again, was sort of ignored by the market nearly. And, the US dollar was very strong in the lead up to the FOMC. But just to touch upon what we do have later today, we do have a little bit of news coming out. We've got building permits. The Philadelphia Fed Manufacturing Index expected to be a little lower. Building permits a little lower than October. But frankly, what we might see is that the US dollar just sort of settles around here, 96.20, 96.40, I would likely see. And I just want to quickly touch upon the 2-year bond yield, which is interesting. It almost replicated the chart of the US dollar index as well. So what we are seeing here is that, in the anticipation, obviously, to the release, participants in the bond market were thinking, all right, this is, going to potentially be something, dramatic, but they did stick to what they had discussed. And there was some pre-warnings with what Jerome Powell's been talking about, how he shifted his language. So watch for the 2-year a little bit. We've got 71 or so is the high. And if we go to the 1-year chart, just to put it in perspective, so we'll just see how this goes. And if we see this pull back, we might likely see the US dollar sort of pull back as well. But we are in a very well-supported area as well, in the 67, 65 is sort of the bottom, or 63 is the bottom. So just watch for that to perk up a little bit, even tonight, and we could see a little bit of a shift to risk on potentially. But again, the markets are a little challenging. So, again, we've mentioned Forex briefcase a few times. It's a nice way to spread the diversification around a little bit too. So I've shared the link in the chat for that. Now, we still have a little bit left to go through. We've got yen, and we've also got gold with Jin here, who I think got a few hours sleep. So thank you, Jin, for turning up to the call. I was ready to take it just in case. Silly me, though, because Jin doesn't need much sleep, but he is around and ready to talk yen and gold. So over to you now, Jin.
It's okay. You can take over. So back to you, Scotty. All right. So what else can I say? Analysis for FOMC done. If you were not trading the FOMC, then the move is done. It's completed. If you want to try and catch on to the next wave of the move, you're probably a little bit too late or very late. I think that as much as the news that was released has changed the perspective of things, we are heading towards the end of the year. We're next half of the month, we're towards the end of the year. I think that we're going to see volatility drop off quite a bit. Even for our club members, a lot of them have signed off saying that they're going to take the next couple of weeks off, and we're heading into a brand new 2022. So what to look out for? We do have a news tonight. We do have one news left, or a couple of news left tonight with, oops, where am I? Hang on, I froze. Okay, I'm back. See, not just Kim Hong. Kim Hong, it's not just you having computer issues. I have computer issues too. We all need new laptops. Anyone who is watching this, any laptop providers, we all need new laptops. Thursday today, we have done the FOMC news and all that. With all that news released, next thing to pay attention to is the Bank of England's rate decision, which we went into quite a bit of detail, or the Kim Hong went into quite a bit of detail yesterday, telling you that rates are likely to hold, but pay a bit of attention to the voting there. So this will have, or is likely to have, some impact on the pound yen. So we're looking at the yen pairs today, so that's why I'm looking at this in terms of the pound yen. No major, some might have some surprises, but no major surprises coming from the ECB at this point for tonight at 8:45 GMT +8. And then for the US data to be released, we have housing starts, building permits. I think in the scheme of after a FOMC news, these are not going to move prices too much. I think we might see some continuation, possibly a bit of a fake out before it resumes back to that retracement that we see right now. And then on Friday, some CPI numbers coming from the Eurozone. This again might impact the Euro Yen when we look at it shortly. So with all that put together, jumping to the charts, here, I actually have it on the H1 time frame just to let everyone else who's watching now and didn't jump onto the live trading call last night, where we did last night on Wednesday nights. And those of you who are watching on YouTube and you're not a club member, make sure you jump on. The links are there in the comments and all that. Make sure you jump on as a club member, because just last night during the live trading session, I was doing the analysis on the H1 time frame leading up to the FOMC news, saying that for US yen we could be looking to buy above 113.92. That's where this green line was, anticipating for it to test that 114.45. It came about 16 pips away before it retraced back down. At this point, now back to the currency call, we are anticipating it for it to sit across a little bit before testing higher. I think that for any move, for completion of this move, I would anticipate it to sit across before testing higher. That 114.45 would be a key level to test and possibly to reject, similar to what happened back in November. Test that level and reject. So I'm looking for that move. I don't think it'd be a good trading opportunity. 30 pips towards that resistance level would not be something that you want to jump in and closely manage. A lot of other trade opportunities rather than the US yen at this point. Just note that you have missed that move. So it's a little bit too late to jump into it already. But with that said about the US yen, looking at the Euro yen, same thing. We were saying that if it broke above that recent high point, we were anticipating it to go test at 129.13. This is on H1 time frame. It came to about 128 or 129 before consolidating right now. With it on the H4 time frame, I'm still anticipating it for it to test that resistance. What I would be looking for, in fact, is as a trading opportunity whether it would reject that 129.13 and come down to test 128 or 128 flat. So what you could be looking for as a trade opportunity will be to sell the Euro yen on the under 128.95, under 128.95, about a 30 pip stop loss for a good almost 90 pip take profit level, or 1:3 risk reward ratio towards the downside, trading within that range. Ideally looking for that repeat of what happened last week, where it tested that resistance and turned back down. I'm looking for the same thing to happen. That might come around if we see no big surprises coming from the ECB tonight as well. We might see that push back down. So that's one trade either there. Pound yen, we had the view that we shouldn't do anything last night. We were waiting for it to track up, looking for it to test and reject that 151.38 level. It's done that. It's done that exactly. It's tested 151.38 and looks like a rejection is forming. Looking at it on the H4 time frame, what I would be looking for is for this candle to close, maybe on the next candle. Then I'll look to sell it down. So I'll move this slightly like that. So with the Bank of England's rate decision, if they turn towards a little bit more of a dovish view, being a bit more concerned about Omicron variants, they just had record high infection rates, I think just yesterday. What we could see is that turn towards being more conservative in terms of the rates increase, in terms of their likelihood to increase rates. You could be looking to sell below 151, looking to sell below 151, about a 50 50 or 60 pip stop loss towards a 150 take profit level. You're looking at a 1:3 risk reward ratio towards the downside, trading within this range again. If I zoomed it out a little bit, you can also note that the pound yen tends to trade in a bit of a range before that big breakouts. Same thing in this range. We saw it sit within this range for an extended period of time before breaking higher. I think we're going to see it test lower, sit within this range, probably up until next year before we can see it bounce possibly back up again. So quite quickly, that was the US yen, no trade at this point, a little bit too late to jump into anything. The euro yen will be looking to sell it down if it tests a little bit higher to reject that resistance. And for the pound yen, rejection seems to be forming. It seems to be a little bit early now. I think the next candle, H4 candle closing towards the downside would be a great, almost a textbook selling opportunity. Same like what happened probably about 2 weeks ago, testing lower, testing that 149.39 support. And lucky last, looking at gold, where we talked about it last night, I was saying that we could see it test that 1777 level, and it's shot all the way down because of that dollar strength before retracing back up towards 1777. At this point, same thing back to the daily time frame. I anticipated to test this support further. I think that if I were to tune this, it might look like that. We'll see it sit across, possibly test, look like it's going to go down, but not really tracking lower before that big bounce back up again. So again, for gold, looking for buying opportunities above 1789, possibly back up towards that 1896, or more specifically, that 1866 level, the recent high points for gold. So very quickly, there was quite a few trade ideas there. You might want to think about some trades. You might be a little bit late to jump into that before, you might want to consider the Bank of England news and also the ECB news to be released today before you jump into any of those euro yen and pound yen trades. I saw a message, just let me check that. Okay, so there was a bit of a question. I'll just do that as well, Imran. So we shared, this was actually a really good trade that Imran spotted last night. One of our club members, Imran, spotted last night. The pound New Zealand dollar, we were looking at it at that point, at about that 1.9631 level, just as it was forming, just as that double top was forming, that rejection of that resistance level. I think Imran jumped into that trade, a very good trade towards the downside. I think we're going to see that consolidation a little bit before possibly continuing lower again. So that was one of the trades that was shared during the call. I think there was a follow-up post in the club platform as well. So yeah, that was a good trade. I think it might bounce a little bit before tracking lower. Why I think it might bounce, looking at the pound dollar and also the New Zealand dollar, possibly going to see it consolidate before possibly tracking lower. I hope that answers your question there, Imran. And with that, I'll pass it back to you, Scotty.
All right, thanks for that, Jen. And the trade ideas have been shared in the Traders Club as well. Remember, if you're not a member already, sign up using the website Jindal Thai that's in the video at the bottom there on YouTube if you're watching it there. And hope to see everyone in the club. And tomorrow we've got CAD and crypto. So hope to see everyone on the call as well. Thanks for watching, and bye for now, everyone.